Hi, my name is Liz Thompson. This is a video for IME 315 Financial Decision Making for Engineers at Cal Poly San Luis Obispo. This is a video on calculating pre-tax cash flow.
So when we talk about the 5 topics that are covered in this class, this particular video has to do with investment analysis. So if you remember when we were talking about accounting, I talked about this concept of entity, and it really has to do that who are you looking at when you're looking at the cash flow. So similar to who are you looking at when you're looking at accounting, who are you looking at when you're doing the cash flow. So in this case, we're talking sort of about the business. And so we're looking at cash that goes in or out of this business. And so it's important to understand those concepts, the in and the out for this entity. And this is only when transactions occurs in an accounting system, but when we're doing a forecast, we will want to be considering things into the future. So when we talk about this, we want to account for all the money that comes in and out of the entity. And there's concept associated with that, the pre-tax, and we're going to be talking about pre-tax, and we're going to talk about the things that come in, which have to do with higher sales or lower expenses. New loans is also an inflow, and selling ownership to somebody, that would also be an in. Or if you're selling a, not just a product, but if you're selling a particular capital expenditure, like a piece of machinery, that would also be an in. The out are increased expenses, any kind of capital investment that you make, and a repayment of loan. Now, on an after-tax basis, which is actually usually how companies do the analysis is on after-tax, we consider the taxes that are going out. And we'll talk about this later, but in this video, we're going to be considering only the pre-tax numbers. So when we're looking at this, we want to see things like for pre-tax cash flow, we're going to add sales, add lower expenses, subtract costs of goods sold or increased operating expenses, subtract capital investment, add new loans, subtract loan payments. Now, remember when we talked about the alternative analysis, we're only looking at how things change with the particular investment. So all of these items are changes from a status quo. So if I was going to change something, how would the cash flow change? So let's look at a couple examples. In this case, we're asking for an entity, what would happen to cash flow? If you have been asked to consider the purchase of a new machine for production that will lower labor costs by $10,000 per year for 7 years. There will be an additional electricity cost of $2,000 a year, and the cost of the new machine is $50,000. So let's look at how that looks like in cash flow. So we have for years 1 through 7, we have lower expenses of $10,000, but higher operating expense of $2,000. So that means the pre-tax cash flow will increase by $8,000. And we have the $50,000 one-time investment. So the cash flow will look like this. And then we can do analysis in order to understand what is the comparable value of this. Another example is a new feature on a product that you're designing will improve sales by an estimated 3,000 units per year. The profit margin, or the price minus variable cost, is $4 a unit. But the initial cost of developing this feature is $100,000. So use a 10-year analysis frame. So we are going to look at this, and the higher cash flows for year 1 through 10 are really just higher pre-tax cash flows of 3,000 units times $4 a unit, or $12,000. And then, so that's what it looks like. We're going to invest $100,000 for $12,000 for 10 years. Now, I hope that helped you to understand the concept of pre-tax cash flow, both in lowering expenses and increasing sales. So this particular video was regarding investment analysis.